Hi, this is Derek Hodges of Anchor Point Wealth Management. With the third quarter ending recently, it's a good time to look back at the key investment trends of the last 5 years. The 5-year period is a part of the bull market in stocks that started in March 2009, as the economy emerged from the worst financial crisis in decades. After rising steadily in 2012 and 2013, the Standard & Poor's 500 traded sideways from mid-2015 to mid-2016, nosediving 3 times along the way. Share prices broke out after the November 2016 election, and they've climbed steadily since then. The expansion is now the second longest in modern U.S. economic history. Over the last 5 years, the S&P 500 total return, which includes reinvestment of dividends, was 94%. Without dividends, the average price of a share in the S&P 500 soared 75%. While U.S. stocks are the key growth engine in diversified portfolios, stocks are only one part of a prudent portfolio. This chart shows the 5-year returns on a broad set of indexes representing 13 asset classes, including the S&P 500. The 68.4% loss in S&P Goldman Sachs Index tracking crude oil's price gives you a clear indication of the risk of investing too much in any one industry, asset class, or style. Real returns were strong in this 5-year period, which is characterized by a remarkably low inflation rate of less than 2%. The Standard & Poor's 500 showed a total return of 94%, double the return of major foreign stock markets. America led the world economy out from the severe recession that followed the 2008 financial crisis. The U.S. bounced back before and more than any other major world economy after the Great Recession, and this 5-year period is replete with evidence of American exceptionalism. It's actually pretty amazing. At the bottom of the pack, in last place among 13 asset classes shown, was crude oil. The price of oil dropped globally because of the surge in U.S. supply that resulted from the shale fracking revolution. Some economists say that oil prices won't ever recover back to $100 a barrel because U.S. oil production would increase and fuel lower prices. Commodities and gold were losers over the 5 years due to the strength of the dollar, slowing demand for most commodities, and low inflation. The Standard & Poor's 500 has been breaking new all-time highs for months, and stocks are trading near the high end of their historical valuation range. Larry Fink, the CEO of the world's largest investment manager, recently issued a warning about the stock market. As this long bull market grows older, the statistical likelihood of a bear market, a drop of at least 20%, does indeed increase. But fundamental economic conditions that have accompanied bear markets in the past are not present at this time. We're not seeing restrictive Fed policy. Economic growth isn't slowing. Stock investors are not irrationally exuberant. A correction of 10% or 15% is always possible if there's a change in sentiment or unexpected bad news. Yet the economy shows no sign of coming undone in the foreseeable future, and the bull market could also go on longer and head much higher. All recessions in modern U.S. history have been caused by the Fed, usually because the Fed tightened credit too much to squelch inflation. In the current economy, inflation has been below normal and lower than expected. That's giving the Federal Reserve added leeway to let the economy run faster without worrying about igniting inflation. The new numbers from the government showed that oil prices rose in September because of the disruption from hurricanes hitting the Gulf Coast, but inflation otherwise remained benign. Please contact us with any questions or to set up a meeting, and don't hesitate to share this video with people who might benefit from our work.